So it's time to unveil and review my entire passive income dividend portfolio. I did this back in February, and that video is my #1 video by far, which almost has 120,000 views on it. So obviously you guys are very interested and curious to see my portfolio, which is great. That's why going forward, I will be doing this video every single month so you can actually follow my personal investing journey progress and see how easy do-it-yourself investing really is. My goal is really not to show off, guys, but it's really to motivate you and hopefully to help and inspire you on your own investing journey so you too can become financially independent one day and join the FIRE Club. That's always been the mission of this YouTube channel. I'm trying to show people how easy it is to really manage your own investments without the help of a financial advisor, a financial institution, or even a robo-advisor, which are getting more and more popular these days. Why bother when you could easily do it yourself, right? Especially with my passive income investing strategy. So just a quick summary of my investing strategy and philosophy. So I am a long-term buy and hold income focused or income seeking investor. So the primary objective of this strategy is really to generate a consistent passive income via dividends or distributions every single month to pay off my living expenses. So this means I only invest in stocks or funds that provide a dividend or a distribution with the intent of holding them for a really long time, if not forever, to really live off the passive income that they provide. So this strategy enabled my wife and I to become financially independent or financially free in our mid-30s back in 2019. So my strategy, it might not be fun, it might be not exciting or mainstream, but I can promise you that it does work. You just need to stay focused and you just need to be disciplined. Slow and steady wins the rat race. Don't forget that. So 4 quick things before I show you my entire portfolio. Number 1, I will be showing you my portfolio this time quickly, directly in my broker accounts. So you could really see how my accounts are doing in terms of value. So I get many criticisms that with my strategy, I won't get much capital appreciation at all. This is simply not true. Even if it doesn't rise as fast as mainstream investments like index ETFs, the funds that I own still follow the stock market overall. So don't forget that my overall goal is really the income or high income, not growth. I really couldn't care less about capital appreciation. Is it nice to have? Of course it is. The answer is yes. But when you intend to just buy and hold and never sell anything, it's really not that important. Trust me. The income is, because that's what I use every single month to pay off all my living expenses. So that's really the big advantage, in my opinion, of my strategy, not caring about the fluctuations of the stock market and your account value, because capital appreciation is not how I'm making my money, or it's not how I'm making my returns. I get it from the income. So once that's done, I'll show you my portfolio from my spreadsheet and we'll go through each fund one by one. While I go over them, I'll also share with you any changes that I made to the portfolio since unveiling it back in February, because I'm still in the process of actually cleaning it up and streamlining it by reducing some more single stocks and single REITs that I own, because I'm really heading towards really ETFs and split funds and income funds because they're simply less risky than owning the single stock. Number 2. This is my main portfolio, guys. It's made up of 4 accounts combined. So it's my TFSA, my wife's TFSA, my regular cash account or non-registered account, whatever you want to call it, and my wife's cash account, non-registered account. So this does not include the RRSP accounts. Those are completely separate, and I have a video covering those 2 RRSP accounts in detail. So if ever you're interested to know what we hold in our retirement accounts, you could check out that video. The reason I keep it separate is really because of how the RRSP accounts work. As you know, you can't withdraw any of the money until later on, until you turn it into a RIF account. So we'll probably wait until our 50s to do that, or maybe later, we'll see. So the dividends and distributions in our RRSP accounts or in our retirement accounts are compounding every month, either via the drip or manual reinvesting. So I show this in my RRSP video in detail, so make sure to check it out if you're interested. Last but not least, you could download my entire spreadsheet that I'm about to show you for free on my website, passiveincomeinvesting.ca. You just need to click on the free tools and resource section at the top of the homepage. It will be the very first download, so very easy to download, guys. So without further ado, let's check out my entire portfolio together. So we'll start with my accounts, guys, directly from my broker, my TD broker. So this is my regular cash account, my non-registered account. And as you can see, total value of 303. Book cost is 246. So overall in my cash account, I'm actually up $57,000 or 23%. So the reason why I really wanted to show you this, like I mentioned before, is I get a lot of criticism that says, well, your capital will never grow as a passive income investor. Well, here's the proof. It will grow. It will follow the overall stock market. I did sort it here from the biggest losers to the biggest gain. And as you can see, my biggest loser is by far Vermilion Energy. So I'm down 64% on it. There's also Financial 15, down 16%, not so bad. I'm really down on it, even though it's recovered a lot lately because of the share price consolidation it had in December. Don't forget that I had Financial 15 for over a year. And also another loser is Morguard REIT. These guys own a lot of malls. So I'll talk about that when I show you my spreadsheet. But the biggest lesson I could show you guys is that if you really want to avoid volatility or capital losses, well, stay away from single stocks and single REITs. That's what I'm trying to do. That's why I keep telling you I'm doing a cleanup of my portfolio. I'm getting away from single stocks and single REITs because those are the ones that are most at risk. Not only price fluctuation, but also dividend cuts, like Vermilion here, like Morguard REIT. This is a single REIT. Kiera, single stock. So, and as you go down, well, everything is pretty much gain. Or capital gain, and altogether I'm up 23% in my cash account. In my TFSA, this is my TFSA. I'm actually down a little bit here. Let's just refresh it. I'm doing it live here just to show you that I'm doing it live. So I'm down only 6% on it, which is really not so bad. These are all my holdings, by the way, my TFSA. I just want to show you because I get a lot of questions, a lot of concerns about this, saying, well, what do you hold in a TFSA versus your cash account? The honest answer is, for me, it doesn't really matter. Me personally, we try to keep our REITs and our higher yielding funds in our TFSA. So mine specifically has a lot more of the REITs. You could see here, American Hotel is a REIT, Pro, Slate Grocery, B2B, Nexus, True North. So these are all REITs. So I have mostly REITs in my TFSA account. And my biggest losers, once again, is Financial 15, because like I said, I owned it before the price consolidation. Here's another single REIT that I'm really down on, minus 42%. So this minus 4,600, well, 2,500 of it is coming from American Hotel REITs, which I'm still going to hold on to it because they've been having a really hard time. Obviously, they own hotels in America, and because of COVID-19, it really struggled. They struggled. So I'll discuss it more when I show you my spreadsheet. But I just wanted to show you guys my our accounts first directly in the broker. So now let's move on to my wife's two accounts. All right, so this is my wife's cash account or non-registered account. So she's also up in her account as well, up 29 grand or 11%. And once again, I sorted it via the biggest losers at the top. So Invesque is the biggest loser for her right now. This is, of course, no surprise, another single stock. And in second place, Morguard REIT again here, which is a single REIT. So once again, guys, you don't want any capital losses. Just stay away from single stocks and single REITs. But either way, everything else besides those two is pretty up there. Of course, Financial 15, once again, I'm down on it a little bit, but everything else, if you scroll down, I'm pretty much up on here. And yes, by the way, we did bite the bullet and decided to go in and invest in Bitcoin, only $2,000. So this is the Bitcoin ETF. So this fund is excluded from my income portfolio simply because it doesn't provide any income. But honestly, we just bought it for fun. And as you can see, as I go down, the gains are getting bigger and bigger and bigger. So overall, once again, I'm in the green for this account here, up 11% here. In the TFSA, so this is her TFSA. Hers is doing much better than mine. She's up 19% or up 14 grand here. And as you can see in her TFSA, we decided to put really the high yielding funds that we have. So a lot of split funds. You have Dividend 15, GDV, LBS, ENS, EIT, SBC. So mostly really the high yielding funds. And I'm up, or we're up rather, on every single one. So up $14,000 here. So just to show you overall, guys, the most important thing when you're just trying to decide what to put in your TFSA or not, it's really not that important. The important thing is to really max out your TFSA as soon as possible, because it's all tax-free income. And if you're like me, you want to keep growing your TFSA contribution room, well, put the highest yielding funds that you have in your TFSA. Because if you're like me and extract the income every month, well, that whatever you extract, don't forget, from your TFSA can be put back in the following year. So next year, just to give you an example, my wife's TFSA makes about $6,000 a year, which I extract every month, right? So next year, if the limit is once again $6,000, well, her new limit will be $12,000 because of all that income you extract. So it's a really cool trick to really gain more contribution room by putting really the high yielding stuff in the TFSA, because you extract it every month. As simple as that. So now let's go over the spreadsheet, guys, which is basically the combination of these 4 accounts, and we'll go through the stocks and funds one by one. So here is my portfolio, guys. Here is my spreadsheet. I'll go through all the stocks one by one. So just quickly, so you understand what you're looking at here. This is simply the name of the stock here, the stock symbol or the ticker symbol. The details of the fund. This is I put this manually myself. How much investment is how much money I put into the fund. The weight is how much percentage-wise does it make up of my total portfolio. So Canoe EIT, for example, makes up 4.58% of my total portfolio. How many shares do I have? Share price, so this is my share price. This is my average share price, or my ACB, my average cost base. And the yield, so how much yield I'm currently making on it, okay? Not what the stock is currently offering right now. Most of the stocks, because I'm up on them, it means that the yield right now that they're giving is a little bit lower. What the annual dividend is, the annual income, and the monthly income. So let me just zoom in here and make it a bit clear for you guys. So we'll go through each section. We'll go through my income funds first, then ETFs, split funds, single REITs, and single stocks. So starting with the income funds, I absolutely love income funds. Canoe EIT is my first one. It's the biggest holding in my portfolio at 30,000 here. I absolutely love this fund. It's an income fund based in Canada. It's Canadian listed, of course, and it's the biggest closed-end fund in Canada. It has been giving a 10-cent a month distribution since like 2008, so almost 13 years now. This is just the epitome of consistency, of income consistency. If you ask me, I've been doing great on it, and it's definitely one of my top, if not the top income fund of all time for me personally. I will make a video on this fund alone coming up. My next 2 are from Brookfield. These are the 2 income funds or closed-end fund that Brookfield offers in Canada. So the first one is the Global Infrastructure Securities Income Fund. Like the name says here, it focuses on infrastructure. So a lot of utilities, a lot of water treatment, bridges, airports, everything that has electricity, renewable power, everything that has to do with with infrastructure, which, by the way, real estate as well. So Brookfield, if you didn't know, is really specialized in infrastructure and real estate. That is their specialty. So really cool income fund here. Even the second one here, this is the smaller fund, Brookfield Select Opportunities Income Fund. This fund continues to baffle me because I don't understand how they could keep a really high dividend. It's so high. I mean, I booked it at $3.58. Right now, it's like at $5. So I booked a yield of 16.76% on it. I think it's my highest yield, or one of my highest yields in my portfolio. So it's performed absolutely phenomenal for me. In terms of getting them right now, I wouldn't suggest grabbing these 2 right now because they're trading at huge premiums, which means that their stock price is a lot higher than their current NAV price, especially BSO.UN. It's like more than double the amount, which is absolutely crazy. I just don't understand this one, but hey, it's doing well for me, so I'm just gonna hold on to it. But I probably won't add more money in these two. So the next two are from Quadravest. Quadravest specialize in split share funds. They have about 13 funds total. And now 11 out of the 13 are split funds, but these two are not split share funds. So you have, and they're absolute gems in my opinion. So you have the Dividend Select 15 Corporation. Stock symbol is DS. So this one focuses on it's basically a mirror image of DFN or Dividend 15. They have the same companies, except there's no split share rule with the $15 unit NAV threshold rule. So what's interesting about this one, and also Income Financial Trust, which is my go-to when it comes to financials in North America. Inc.UN here has about 50 funds, 50 stocks, all financial stocks in North America, so Canada and US. So you have the big banks here, big insurance companies, and big asset managers. A really, really amazing fund. What I really love about these two income funds is their dividend policy. So what they do is they apply 10% to the stock price to actually get the dividend for that month. So it's a bit complicated. I have a video out on these two and how it works. So basically, if the stock price goes up, and here's the key, the dividend goes up. So the stock prices have been going up. I mean, DS is over 7. I have it at 6.11, and Inc.UN is at over $11, and I booked it. My cost is 7.57. So when the dividends go up, my yield goes up. That's why I'm making such enormous yields off these guys, especially Inc.UN. This is probably one of my best buys during COVID-19. I added more to it, and look at the yield I'm making on it, almost 15%, even beating EIT. The thing is, if you buy it now, you're only going to get 10%, right? So that's how these funds work. They always trigger a 10% dividend yield, but if you buy the stock cheap and it goes up, well, your dividend increases. Your yield increases like minus. Last of my income funds is a US listed stock. I only have 3 US listed funds in my cash accounts. I have most US listed stocks in my RRSP accounts for the simple reason that you don't have to pay the 15% withholding tax if you hold it in a retirement account. So for this one, I do pay the 15% withholding tax, but even so, I'm making a yield of 13.47%. So I've actually incorporated minus 15% in the yield. So CLM is basically what I like to think as the big closed-end fund in the US that really has the most extreme income. I mean, this fund is really, really, really high income. I think it's giving about 14% right now. And I like to compare it with the EIT in Canada. So really, really good fund. If you want really high income, you do have to pay that 15% withholding tax unless you hold it in an RSP. That's why I have a lot of CLM in my RRSP. All right, moving on to ETFs. All right, so my ETFs, let's start with my BMO ETFs. BMO have some of my favorite covered call ETFs in Canada. Really, really amazing because most of them are already diversified and focus on certain regions. So the first 3 do just that. You have ZWC, which has the top dividend stocks in Canada, mixed sectors, ZWE, the top dividend stocks in Europe, and ZWG, the top dividend stocks in the world globally. But they do focus, or ZWG focuses on US stocks simply because the best blue chips in the world are from the US. So I used to also have ZWS. ZWS focuses on, just like ZWC and E, on a specific on a specific region in the US, but I simply swapped it out for more ZWG for exactly what I said. It's because ZWG focuses on US anyway, so I just got rid of ZWS and rolled it into ZWG to simplify and streamline my portfolio. ZPH is a very interesting fund that uses a put option strategy instead of a covered call option strategy, which means it doesn't really hold anything. It doesn't hold the stocks like the covered call ETFs do, which means it's a lot safer because it barely holds anything. So this is definitely one of my go-tos when it comes to safety. It's something I prefer over preferred shares, no pun intended, or other fixed income instruments like corporate bonds or government bonds. I prefer a put option ETF. I will make a video soon explaining how these put ETFs work. ZPH is not the only one out there, so I'll go through that in a video coming up soon. ZWU I absolutely love because it focuses on one of my favorite sectors, or my two favorite sectors rather, on the stock market: utilities and telecom. So when you hear utilities, think of electricity. When you hear telecom, think of communications, or voice and data, cell phone, internet. So ZWU holds the biggest utilities and telecom companies in North America. We're talking about Bell, Telus, Rogers, Fortis, Emera, Algonquin, Verizon, AT&T, Duke Energy. So all the best ones, all in ZWU. Plus, with the cover calls, you're getting a nice dividend yield of over 7%. So this is why I don't hold any utilities stocks, even though they're really great stocks. I don't have Fortis on its own, or Emera, even though the YouTubers are always talking about those same stocks, or Telus or Bell, or those are all great stocks. But why own them individually? Why, when you could just get ZWU and make a much bigger yield on them? No brainer if you ask me. ZWK, the last one from BMO, focuses on the top banks in the US. So we're talking about JP Morgan and Chase, Bank of America, etc., etc. I was fortunate enough to buy a lot of this during the crash, so my yield is over 10, a little over 10%, whereas right now the yield, because the price recovered, I think it's over $30. It's giving a yield of about 7% or something like that. Still pretty good, but I was lucky to pick some up because financials are always along with Inc.UN, right? Same story. Financials always suffer during stock market corrections and crashes. So that's when you should pick up financial stocks. So those are the BMO ones. The next four are from CI First Asset, another one of my favorite fund managers when it comes to covered call ETFs in Canada. They have really smart sector specific ETFs. So the only thing that I need to tell you about is that these guys offer or give their distributions quarterly opposed to monthly like BMO does. So not really a big deal if you ask me. It is nicer to get monthly opposed to quarterly. And also they fluctuate. The distributions are different every quarter. So FLI focuses on the top 10 North American life insurance companies. So we're talking about Sun Life, Manulife, MetLife, Great West Life. So really the top 10 in North America. There's 3 from Canada and 7 from the US. Really, really smart. I haven't seen an ETF or many ETFs or financial ETFs that focus specifically on the life insurance companies. They usually focus on the bank. So this is a great way to get specific access to life insurance companies or life cos. I thought this was a really smart idea. NXF is where I get my pure energy exposure. I'm not too big on energy, especially the oil and gas producers. I prefer the midstream companies like Enbridge, but NXF really holds the 15 biggest oil and gas producers in the world. And here's the cool part, excluding Canada. So there's no Suncor, there's no natural resources company or anything like that. Nothing in Canada, which I think is really good because Canada has a lot of high taxes and these oil and gas producers really struggle. So this is a cool way to get really the biggest boys in the world. We're talking about Chevron, we're talking about BP, Total. There's a company from Ecuador in here, or Colombia, I think it was. Shell is in here. So really only the big boys, no junior or mid-size energy oil and gas producers. And CGXF is where I get my gold miners and producers stock. So only the big boys, only the big blue chips. So we're talking about Newmont, we're talking about Barrick Gold, Yamana Gold, etc., etc. So only the big guys. And this fund is actually really discounted right now. It's been a stock pick of mine in the last couple of months for the simple reason that gold or gold miners does not do well during a strong bull market. They do well during a market crash or market correction. So this one really peaked in 2020 because of the market volatility, but it's been going down, so I added a little bit to my position here. Last but not least, from CI First Asset is TXF. So this is my go-to fund when I want pure technology exposure. So it has really the top 20 or 25 technology companies in the world. So we're talking about Apple, Microsoft, Nvidia, AMD. So not only Apple and Microsoft, but also the chip makers, the Cisco, the network guys. So all the best technology companies in the world, all wrapped up in one ETF, which writes covered call options. And tell me where you could get a 13% dividend yield with technology companies. If you find something better than that, you let me know about it. Next two are from Harvest, another one of my favorite covered call ETF providers. HHL is definitely their biggest and best fund in my opinion. It focuses on healthcare, so this is where I get my healthcare exposure specifically. So HHL, an amazing fund which has consistent monthly dividends. I'm at 9 right now. I think it's giving 8.8 or 8.75, something like that. So we're talking about AstraZeneca, Johnson & Johnson, Pfizer, the guys in Europe. So only the big Novartis, so really the big pharmaceutical and healthcare companies in the world. HUTL, is also focuses like ZWU on utilities and telecom. The only difference is that it focuses on global utilities and telecom, whereas ZW is only specifically to North America. So it's a cool way to get really the big telecom companies in Europe, like in Sweden and Norway and Finland. They're all included in HUTL. So you get HUTL and ZWU. You got the best utilities and telecom companies all over the world. Absolutely phenomenal. IDR is from Middlefield, who is a real estate expert. So this is my pure real estate ETF. I think it's one of the probably the best ETF or non-covered call play when it comes to real estate out there. The dividend yield is a little over, it's about 6.5%. It's at 6.5% right now. So this is a great fund if you're big on real estate and you don't want the covered calls. You're banking on or you want to capture the full growth of real estate. So this is a really good fund ETF for real estate. It beats VRE or XRE from iShares and Vanguard, those ETFs in my opinion, because the yield is higher and it's not a complete index ETF. It's half index and half active management. So really good if you want real estate. QYLD and RYLD are my last two funds that are US listed. So besides CLM, these are these are the only three that I have in my cash and TFSA accounts that are US listed. So I do have to pay the 15% withholding tax, but regardless, I'm still making some nice yields here, 9.78 and 10. So QYLD focuses or follows the NASDAQ 100 index, which is mostly technology stocks. So it really complements TXF nicely, if you ask me. Really, really consistent and high income. RYLD follows the Russell 2000 index, which is an index that measures 2000 of the smaller to mid cap, really good companies in the US stock market. So really, really solid monthly distributions here, especially RWILD. RWILD has been doing absolutely phenomenal. Their distributions just seem to be going up every month. Finally, you have Horizons Gold Yield. So HGY, this is to complement CGXF. So CGXF focuses on the gold miners and producers, but HGY just has gold, the physical gold or the bullion. So they basically sell covered call options on the physical gold itself, which is great. I don't have much here. I want to add a little bit more in the next couple of months, especially now because gold is very weak. Same like CGXF, right? I mean, gold and gold miners are very weak during bull runs. So now is a good time to pick this one up. A dividend yield is only about 6% on this one, but hey, it's better than stashing a gold bar in your house, not making anything for you, right? And last but not least, this is really the only growth ETF or growth specific ETF that I have. It's HMMJ that focuses on the cannabis sector. So I'm really bullish on cannabis. Personally, I think that it's going to grow over time. So this is one of my very, very few growth plays that I have. This one and the little Bitcoin exposure that I have. But what's cool about this ETF is they still give a quarterly dividend. They do it because of securities lending. So I have a couple of videos just on this fund, so I won't get into it here, but this is how I get my overall cannabis exposure. So moving on to the split share funds, everyone's favorite, right? The big high income funds. So the first one is Dividend 15 from Quadravest. This is their flagship split share fund. So this is definitely by far their number one split fund. So this focuses on 15, like the name says, Dividend 15 of the top Canadian dividend stocks out there. So the big banks are there, the life insurance companies, Enbridge, TELUS, Bell is there as well. So pretty big position here at 25K. And this one, what's really incredible about Dividend 15 is their incredible track record of almost never missing any dividends. I mean, this thing's been around since April 2004. They only missed 4 monthly dividends out of 202 months, which is absolutely incredible. And all 4 misses have been in 2020 because of COVID-19. So I'm making a solid 15% yield on this one here. Financial 15, the other one that I have from Quadravest, focuses on 15 of the biggest financial companies in North America. So 10 Canada, 5 in the US. So I'm only making 10% on this one. And that's because of the aggressive share price consolidation. You can actually see, I put it in my comments. So for every share, you get zero point 0.4 shares. So I literally lost 60% of my shares. But even with that, I did add a little bit to my position recently. I'm still making over 10% yield, which is absolutely incredible. It just goes to show you where, when it comes to split fund, guys, you're not buying them to trade. You're not buying them to sell later. You're buying them to really hold on to them forever. And this guy missed, he was around since December 2003, and they missed 34 dividends out of 205 months. So really, not so bad. But because of the price consolidation, now the unit nav is over $20. So this guy is much safer now. So if ever you want financials right now, Financial 15 would be a really good choice. Moving on to the Brompton ones now, I have 4 of them from Brompton, really good ones as well. LBS, also financial, the big 6 Canadian banks, and the big 4 Canadian life insurance companies. So Manulife, Sun Life, Great-West Life, and IA Industrial, IA Financial, I mean. So this one's been around since November 2006. They missed 18 dividends out of 171, 8 out of the 18, were because of COVID-19. So this one recovered nicely in the last couple of months. I'm making a solid almost 18% yield on it. Really good. I think this is my second highest yield after DGS, which we'll see in a second. SBC, this is my favorite fund where I get my exposure to the big 6 Canadian banks specifically. So I'm going to make another video on the big 6 Canadian banks and what I feel is the best way to get exposure to them. SBC is definitely it. I mean, it's a very safe split fund. Right now it's giving 9% yield, but I booked it at cheaper, so I'm making 12% on it. Absolutely incredible. It's been around since November 2005, and here's the crazy part. They only missed 4 dividends out of 182 months, and all 4 were during the 2007-2008 financial crisis. So I have personally not missed any dividends since I've owned this stock, and that's why it's green and it says my distributions missed 0. Next one is GDD. I made a recent video just on this fund alone. I think it's one of the smartest split funds ever created simply because of its diversification. So as you can see, split funds are usually focused on very heavily on the financials, but this one here, I have to give my props up to Brompton Funds for creating this. Focuses on the global dividend grower stocks all around the world. So not just on financials or not just Canada. So if you don't know what global dividend grower stocks means, it just means dividend stocks that tend to grow their dividend over time. So one of my favorite, if not my favorite, split share fund of all time. As you can see, big position here, just like Dividend 15. And this one has it's relatively new. It came out in June 2018. So it's only been out for 32 months. It has not missed any distributions or dividends, including during COVID-19, which is absolutely incredible. DGS, so I made a video on this one recently as well. So this is a new position that I added to my portfolio. I was a bit hesitant to add it because DFN is a great alternative when it comes to Canadian stocks. So this one focuses on Canadian dividend stocks, but it has a lot more than 15. It has about 30 stocks or so, which I really like. So small position here, 5,000. We'll see how it goes. I'm doing really well on it, and I'm booking an astronomical yield of 22%. This simply means that if this does not miss any dividends in the next couple of years, well, in less than 5 years, I'll already make my $5,000 investment back in dividends alone. So this is really what I like to call a high risk, high reward fund, which I go over and I discuss in that video I was speaking of. Next two actually from both from Middlefield. So the first one is ENS. I absolutely love ENS. This focuses purely on Enbridge. So if you guys like Enbridge like I do, I mean, if you're Canadian, you probably love Enbridge. We all do. This is the best way to get Enbridge exposure because they simply get a really increased yield because like we all know, split funds use covered calls and leverage to boost the dividend yield. So this is how I own Enbridge. I have 20 grand in here. Haven't missed any dividends at all. The fund has not missed any dividends. This is the first time in history I've ever seen a split share fund raise its dividend. which is absolutely incredible. So this is really on a roll here. The unit NAV is like $22, so $7 above that $15 unit NAV threshold. It didn't miss any dividends during the COVID-19 crash. Absolutely incredible. If you like Enbridge, this is how you should own it, in my opinion. RS is a brand new split fund offered from Middlefield. This is the first split fund that focuses solely on real estate. So this is a great way. It's actually a mirror image where it has a lot of the same holdings of IDR, which is no surprise because IDR is also managed by Middlefield. So this is giving a nice a yield of about 8% right now. So I bought it at 13.92. So I was lucky to have 8.62. So this is really brand new. Came out in December 2021 and has only provided 2 distributions so far. So this is a really a baby, but a really awesome way to own real estate and get a lot of income off of it. I have a video specifically on this fund on RS, so make sure you check it out where I describe it more in detail and I explore it in detail as well. All right, so now let's go through my single REITs and my single stocks. So in terms of single REITs, I have 11 of them. I have reduced it. I sold off Ryokan recently in the last couple of months. I swapped it for RS because Ryokan is already in RS anyway. I also sold another small REIT called Melcor REIT, which I distributed to other funds as well. So I'm currently, still in the process of cleaning up and reducing my single REITs and single stocks as I see fit, whenever I see an opportunity. So let's go through what I have here. So Pro REIT and B2B REIT are very, very similar. They're both commercial real estate companies or REITs that focus on Canada. So they have a bit of everything. They have office, they have retail, they have industrial, a little bit of everything. They both reduced their dividend by a little bit, 29% back in April 2020. So I did add to my positions here. So I'm making a decent yield of about 7.5%. So I really can't complain. I'll probably hold on to these two. I'm not sure yet. I'm up on both of them. So I wouldn't be surprised if I decide just to swap them out for more RS eventually or IDR. Morguard REIT is one of my biggest losers. So I'm down on this one. It's at like 5 something and I have it at 687. These guys reduced their dividend twice. So by 50% in April 2020 and another 50% recently in the last couple of months. So the reason why they're suffering or they're doing horribly is because they own mostly a lot of retail, a lot of enclosed malls. So retail is not actually that bad. It's really the closed malls that are bad. So Pro and B2B own a lot of like strip malls and strip centers. So it's open but closed where they had to shut down, especially in Ontario. They have a really giant mall in Ontario, I think. So this one is definitely on my list to get rid of sooner than later. Nexus REIT and Firm Capital REIT are my two great very small cap REITs that are performing amazing. I absolutely love Nexus REIT because they focus primarily on industrial property, which is really, really hot right now. I'm making nice yield on it, 8.85. They recently graduated to the TSX or the TSX Venture. It's been one of my stock picks recently, so really, really cool REIT to own here. Firm Capital Property Trust, very small REIT, still on a TSX Venture, a baby REIT I like to call, but they're very similar to a Ryokan. They have a lot of like retail, but also they're starting to build residential, or they're starting to do stuff like smart centers, city centers. What I like about Firm is that they keep increasing their dividend, which is really, really cool every year. And I think they've increased their dividend by a cent or two every single year for the last 8 years. So I'm definitely holding on to this one. I'm at 8.66. I'm not going to complain. Slate Grocery REIT. This is my hero. This is my best performer by far. So Slate Grocery REIT used to be called Slate Retail REIT. That's why you might have trouble finding the graphs or the old stock price for this one. So they changed their name to Slate Grocery REIT because they own grocery anchored real estate in the US. So that's why I like it. It is all retail, but it's grocery centers, which is all essential services. So they have no problem because of the pandemic. So they've been doing really well. They also announced a major announcement that they bought a bunch of properties lately. So they're expanding extremely quickly. I really like Slate. I also have Slate Office. So yeah, definitely my big winner. And this is actually still giving a really nice dividend yield of 9% actually. So a really good pickup, and definitely my biggest single REIT, which I probably will never sell. Next one is also from Slate. It's a Slate office REIT. I absolutely love this one. My next three are actually pure office REITs, and which a lot of people have been dumping. A lot of people have been scared of because of the pandemic. Everyone's working from home. All nonsense, by the way, all nonsense. These three REITs have not missed a beat. I actually added to my position in them. So you have Slate Office REIT, which focuses on office space in North America, mostly in Canada, though they also have 2 buildings in Chicago, I think. So I'm making 9% here. They haven't touched their dividend because of COVID. They had reduced it back in March 2019 by a big reduction, but I picked some up cheap, and now I'm making 9%, so it's great. True North Real Estate, True North Commercial REIT focus purely on office real estate in Canada, so a lot of government tenants, which is great. So this one has not missed a beat, really, really solid. They kept paying the dividend, no problem. And Innovalis REIT, I like because it gives a good opportunity for us Canadians to invest outside of Canada. So this focuses on office, but France and Germany only. So nothing in North America. So we're talking about, mostly Paris and the big city centers in Germany. So performing really well. My office REITs are, as you can see, some of my best performers, all giving all 9%. Smart Centers REIT is literally the only big cap or big, blue chip REIT, I like to say, that I own. It stayed relatively solid, unlike RioCan that cut its dividend. So these guys did not touch their dividend. I like them. I'll probably hold on to them, even though I'm up significantly on that. I think it's at $27 or $28. I'm at 24. So I might eventually sell it off to swap it for more RS to get 8% instead of 7.6. But I might just hold on to it because they'll probably raise their dividend over time anyway, and I'll get to 8% anyway. And my biggest loser, like I showed you from my broker account directly, is American Hotel Income Properties REIT. So obviously, like the name says, they own American hotels in the US. I don't have too much in here, only 6K, but I'm down like 40% on it. And these guys, this is the only REIT that I've ever seen completely suspend their dividend. So I actually, believe it or not, you want to know a funny story? I emailed their investor relations, and the guy actually called me back. I actually spoke to them on the phone, which is rare. It's rare that an investor relation guy calls you back. And I asked him about the reinstatement of the dividend, and he told me that, like they announced in the recent quarter, they're going to look at reinstating it by the end of this year or the beginning of next year, which is great. So I'll probably hold on to it. I'm not going to sell something that I'm really, really down on right now. There's no point. I'll just wait this one out. In terms of single stocks, I have reduced a little bit. I got rid of Boston Pizza Royalties Income Fund. So I dumped that one. I made a profit on it, which is fine, I got rid of it. And these are the ones that I have left. I only have 10 of them left, and eventually I'll probably get down to 7 or 8. So diversified royalty is really my best one, my favorite one, because I like how the business works. They basically, they buy trademarks from different companies. Their biggest one is Mr. Lube, which is a quick service center for cars. They do oil changes, tire changes. They also own the trademark to Air Miles, and also to Sutton, which is a real estate broker company. So they reduced their dividend during COVID-19 only by a little bit, by 15%. I kept adding to my position here, so I'm at 15,000. I'm making a really nice dividend yield of 8.8, and I have a feeling that eventually they're going to re-raise it back to 23 cents. They really lowered it because one of their partners is a restaurant chain. So I think they'll re-enable it. And if they do re-enable it back to 23, I'll get to 10%, which is really, really cool. Chemtrade Logistics Income Fund, they sell industrial chemicals. I don't really know too much about this business, but I'm getting a decent yield on it, even though they cut their dividend in half during COVID-19. So I'm still getting 6.77%. So this is definitely a contender for me to sell personally. It's not a bad fund or a bad stock, especially if you got it really cheap. In the last couple of months. So it has been recovering. It's at 7 something now. I'm at 8.86, so not so bad. We'll see what happens. Alaris Equity Partners Income Trust, I really like. They basically provide specialty finance to smaller private companies in North America, and they make royalties off the money that they lend. So they kind of become their partners and pay out the dividend, the profits to us, the investors. So they also reduced their dividend from 165 to 116 during COVID, but they since re-raised it to 124. So it's not where it used to be at 165, but I think these guys are eventually going to keep raising it. I'm making over 7, so I can't complain. I'll probably keep it. Bridgemark Real Estate Services. This is the one of my big winners of my only single stocks that I've kept. So this company actually used to be called Brookfield Real Estate Services. So Brookfield actually owns this company, and this is really a real estate broker services company. So they own Royal LePage. So I'm sure you've seen Royal LePage, and they own 2 other smaller real estate broker services. So this is how I like to make my commissions off real estate brokers who make all those really high commissions by selling real estate. So why get mad? Just join the party, invest in this stock, and you can make those commissions off a property sale. So I absolutely love this stock. They haven't touched the dividend, and I'm up on this stock significantly. I booked it at $12, and right now I think it's like at 16 or 17 or something like that. So I'm definitely not touching this one because I'm making almost 11% yield on it. Decisive Dividend Corporation. I'm happy to announce that very recently, in the last couple of months, they finally re-enabled their dividend. So they had a 36 cent annual dividend back in March 2020. They re-enabled it to 24 cents out of an abundance of caution, because that's how those guys are. It's a very, very tiny stock. It's on the TSX Venture, and what they do is they buy out small industrial manufacturing companies. So they're an acquisitions company. They buy out the companies and they run them, and they give out the profits to us, the shareholders. So I'm super happy about this one. They finally re-enabled the dividend. I'm making 8.8 on it. And once it goes back to 36 cents, which they said they might do by end of year, I'll be making 13% on it. So passing, Bridgemark Real Estate Services. So definitely really cool little company here. Would I add more? I doubt it. Invesque is my big loser in my wife's account, like you saw. So this focuses on senior healthcare properties. So I mean, it was just a bad single stock choice. It had a really high dividend that I was attracted to, and they suspended it altogether because of COVID-19, right? They completely destroyed the senior healthcare home business, but it is slowly recovering. It's just past $4 now, or near $4. This one's actually $2 at the crash. So it's recovering nicely. I have it at 669 here, so a little bit more to go to recover. Vermilion Energy, like I showed you guys, this is pretty much the bane of my existence here. It's an oil and gas exploration and production company. It's over $1 billion company, so it's definitely not a Shell or a Suncor, but it's a medium-sized one. What I like about them though is that they have production outside of Canada. They have some in Europe and all over the world. So I'm down like 60% on this one. It's like $8, and I have it at $24. So I'm just gonna have to wait. Unfortunately, Invesque, Vermilion, and American Hotel Income, as you could see, I'm not making income on them. Key Era is a midstream company. I like to call it a mini Enbridge. They haven't touched their dividend, so I'm happy about that. Even though I'm down on it, I have it at 32, and now it's at like 26 or something like that. I'm still making a good dividend yield. It's all a decent one at 5.89. Exchange Income Corporation. This was one of my picks that I actually reviewed in my last video, so it's done absolutely phenomenal for me. Unfortunately, I didn't add too much to this. I only have a small position here. It's like a almost $40 stock now, so I actually did really, really well on it, and the dividend has remained untouched. These guys, very similar to Decisive Dividend Corporation, they're basically an acquisitions company. They buy out manufacturing companies, especially those tied to the aviation and aerospace division. That's why I went down really, really hard during COVID. I picked some up, and luckily for me, they didn't slash the dividend. So I'm making a solid 9 on it. Last but not least, Automotive Finco, stock symbol AFCC. So this is a very small stock or company, also listed on the TSX Venture, like Decisive Dividend and like Firm Capital Trust here. So they offer specialty finance to car dealerships, people who want to buy out car dealerships. And to my surprise, it's been performing fine and dandy. I'm up on it slightly, and they keep paying the monthly dividend, which I'm surprised about. I guess this is one of the few single stock winners that I have here, along with bridge mark, etc. So I'm making a solid 12.42% dividend yield. I definitely wouldn't add more to this one. It's what I like to call a really high risk, high reward stock. But considering it's a single stock, I probably won't add much here. But hey, at 12%, I'm going to keep it and I won't complain. So there you go. That is every single position in my portfolio. Now let's quickly go through my totals, how much money I make every year, how much money have I made in dividends in 2021, and we'll see my average dividend yield as well. All right, guys, so my grand totals, I'll show you how much I've made in dividends so far for the year 2021. So keep in mind this portfolio is as of April 1st, 2021. So total dividends that I've made in the first 3 months of this year is $15,457. In terms of how much money I make right now every year and every month, it's just under 66K a year, and this is dividends alone. And this includes even these ones, they're at zero, right? So I also included them there. So monthly, it's $54.94 every single month. So I'll just make this bigger here so you could see the total. So my total investment, so my portfolio, this is total investment is how much money I put in personally. It's not how much my portfolio is worth. It's actually worth like 750 now because I'm up on it. But this is how much money I put in personally. My average dividend yield is a little over 10%. So it's a bit higher than it was during the last unveil. That's simply because of the moves that I've made, and also Decisive Dividend re-enabled their dividend as well. So that was a big plus. So I just passed 10% yield. So what does this mean to have an average dividend yield of 10%? Well, it simply means, this is how I look at it anyway, that in 10 years, I'll make all my money back, or $655,000 back in dividends alone, which is pretty incredible. So this is why I always say this is a conservative and an easy strategy. You just have to sit there and wait. You're making your money not by trading, not by capital appreciation, not what the stock price is going up, stock market going up. I don't care about that. I make my money with my income. So I make my money with time. All I need is time. All I got to do is sit and wait. And I make 10% a year. So my monthly income right now is just under $5,500 a month at $54.94, and so far I've made 12.66% of my money back in dividends alone, which is simply this number here, dividends divided by total investment. So here you could see my portfolio breakdown. I have 15% in income funds, 28% in ETFs. I want to raise the ETFs exposure here. I want it to be about 30% or 33%. Split funds 23%. Single stocks and single REITs and single stocks are going down. So single REITs at 19, single stocks at 13, and you could see how much of the income comes from the income fund. So although income funds make up 15% of my portfolio, they make up 19% of my overall income. ETFs 28%, and they make 25% of my income. And check out the split funds, the big difference here. So this just shows you how much money split funds really make. They make 30% of my overall income, and then you have single REITs and a single stock. So I do have also a sector breakdown, but not going back and thinking about it, it's pretty useless because I have a lot of stuff that's mixed sector. For example, I mean, it only shows 2% technology, but this is direct exposure to technology. I have, QYLD is not counted in this, even though it's a lot of technology. So this just gives you, I guess, a small idea of my sector breakdown, but most of it is mixed, and as it's no surprise, it's very heavy on the financial. So going forward, my goal is really to get the utilities and telecom as well as healthcare a little bit higher, and mixed sectors is basically my favorite because it's the safest, right? It's a combination of mixed sectors. So there you have it, guys. That is my portfolio. So there you go, guys, my entire portfolio in black and white. As you can see, especially if you're a long-time follower of my channel, I own what I preach, right? I wouldn't feel comfortable suggesting a stock or a fund without owning it myself. So keep in mind, guys, once again, that this is a pure income-focused portfolio, really designed for high income and not capital appreciation, even though you can still get capital appreciation nonetheless. It's a strategy and it's a style of investing that really fits my personal personality and our needs, and we absolutely love it. I mean, this is what made us financially independent at a relatively young age. So am I against the mainstream growth strategy? No, not at all. I used to be that kind of investor from 2012 to 2017. So I simply prefer the income strategy. It's much easier in my opinion and much more hands-off with a lot less stress. So if ever you want to know more about my investing strategy, my investing philosophy, check out the videos I have on that subject. I also have a YouTube playlist for all the videos I made that really talk about my strategy in detail. So there are 4 videos total in that playlist. So I'll also add the playlist in the video description below. As always, please support us. Please support my channel by hitting that like button. It's free for you. It helps the channel out, so it's a win-win. Also, please visit our website, passiveincomeinvesting.ca, to access our digital product, the Ultimate Dividend Passive Income Investing Package, which includes a huge list of ETFs, split funds, income funds, high yield single stocks and single REITs, with my personal comments for each one. Really all the stocks you ever need to build your own portfolio. It comes with lifetime updates, so you only need to buy it once in case a new version comes out. Also on my website, right there on the homepage, you could book a one-on-one video consultation with me personally. If ever you want me to review your existing portfolio, you want my help to build a brand new portfolio, or you just want to ask me a million questions, it's fine. Whatever your needs are, I will do my utmost to really help you and answer all your questions. I love doing it. It's very easy to book an appointment, guys. It's right on my website's homepage. There's a giant calendar there. All you need to do is find an open spot and book the appointment. So I only charge 150 Canadian dollars for the one-on-one, which is very cheap considering what you get and the time that I put in, which is usually 2 to 3 hours per case, if you include the building of your custom portfolio and follow-up questions as well. So I've done over 30 of them in the last couple of months with people all over Canada and also in the US. I'm getting more and more comments and requests from Americans who really like my investing strategy. So if you're in the US, yes, I can help you, and yes, you could book the appointment. I also have extensive knowledge on many funds and ETFs on the US stock market that are designed for income. And to be honest, I'm jealous of you guys, of you Americans, because you have a ton of great funds that are really designed for high income, a lot more than us Canadians do. I own many of them myself, but really in my retirement accounts because there's no withholding tax there. So finally, make sure you're subscribed, guys, so you don't miss out on my future content and videos and community posts on passive income investing, which is really designed to help you on your investing journey. We're also on Instagram and Facebook. Facebook group is growing. We have over 250 now, or 260. So please join our community there if you use Facebook. Our mission, the mission of this channel remains the same, guys. It's to help everyday working people to invest on their own in order to build their own stream of passive income, which will enhance your quality of life. So with that, take care, guys. Stay safe. Please get vaccinated as soon as it's your turn so we could get on with our lives, and see you next time.